the 30-year Treasury bond yield has crossed 5%, marking a significant shift in the financial landscape. This move has raised borrowing costs and is now putting pressure on stretched equity valuations across U.S. markets. Investors are watching closely as rising bond yields tend to increase the cost of capital for both businesses and consumers, which can weigh on corporate profits and consumer spending. The S&P 500 currently trades at 21.3 times forward earnings, a level well above its historical average of 16. This valuation premium suggests that markets may be vulnerable to a sell-off if bond yields continue to climb or if inflationary pressures persist. In the first quarter, corporate profits rose nearly 28% year-over-year, driven in part by increased spending on AI infrastructure. However, the broader macroeconomic picture is complicated by geopolitical tensions, particularly in the Strait of Hormuz, which could trigger a new inflation regime that markets have yet to fully price in. Analysts are warning that equity valuations remain stretched, and a prolonged rise in bond yields could lead to a sharp correction. Peter Tuz of Chase Investment Counsel noted that the fear of inflation becoming embedded in the economy is growing among investors. He pointed out that there are no signs of inflation easing, and that this could drive market declines if it continues. Meanwhile, Paul Carger of Twin Focus observed a divided outlook among ultra-high net worth investors, with some maintaining confidence in the most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Markets resilience and others preparing for a downturn. The 10-year Treasury benchmark also rose above 4.5% last week, reinforcing concerns about the broader yield curve and its implications for equity valuations. Rising Treasury yields can reduce the appeal of stocks relative to bonds, especially when stocks are trading at elevated multiples. This dynamic is particularly concerning given the current economic backdrop, where AI-driven productivity gains are being offset by rising energy prices and potential inflationary shocks from geopolitical instability. The market's year-to-date performance has been positive, with the S&P 500 gaining more than 17% from its late March low. However, this rally has occurred against a backdrop of rising yields and persistent inflation concerns, which may not be fully reflected in current valuations. Investors are now looking for signals that could indicate whether the market is overextended or if the underlying fundamentals can support higher valuations in a higher yield environment. The next key signal will likely come from the Federal Reserve's policy outlook and how it balances inflation control with economic growth. If inflation remains stubbornly high, the Fed may be forced to maintain tighter monetary policy, which could further elevate bond yields and weigh on equities. Conversely, if inflation begins to moderate and the Fed signals a more dovish stance, equity markets could find renewed support. For now, the market remains in a state of uncertainty, with investors closely monitoring both bond yields and geopolitical developments for signs of a shift in the economic trajectory. The interplay between bond yields and equity valuations is a delicate one, with rising yields often signaling tighter financial conditions and a shift in investor sentiment from growth to income. As yields climb, the cost of borrowing for companies increases, which can dampen future earnings growth and reduce the appeal of equities. At the same time, investors are weighing the strength of corporate earnings reports against the backdrop of higher borrowing costs and inflation risks. The AI-driven productivity gains reported in the first quarter have provided some support to equity markets, but these gains may not be enough to offset the broader macroeconomic risks. The Strait of Hormuz remains a most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Focal point for investors, as any disruption in oil shipments could send energy prices surging and trigger a new wave of inflation that could further pressure equities. The stakes are high, with investors now trying to determine whether the current valuation premium is justified or if it reflects an over-optimistic view of future economic conditions. The coming weeks will be critical in shaping investor sentiment, with the Fed's next moves and the trajectory of inflation likely to be the key factors in determining whether equities can sustain their current levels or face a more significant correction. Until then, the market remains in a state of watchful waiting, with bond yields and geopolitical risks at the center of investor concerns.